Hi, welcome back to SharpenPortfolios. In this video, we will discuss the Sharpe ratio, its underlying assumptions, and how to use Sharpe ratios to build sophistication and become a better investor. The Sharpe ratio is an individual investments or a portfolio of investments ratio of excess return to risk. In other words, how much excess return is generated for each unit of risk that you assume. We measure risk using standard deviation. As described in our previous video, the standard deviation is all about the spread of an investment's return over time. More specifically, the standard deviation is a measure of how much the investment's return deviates from its average return during any given period. The standard deviation tells us that about 2/3 of the time, the return of an investment will fall within a band of plus or minus some amount from the average return. And that amount is the standard deviation. For example, if an investment historically returned about $100 per month, and the standard deviation of those returns was $20, we would know that about 2/3 of the time, the returns on any given month would be somewhere between $80 and $120. And so now that we've understood risk, let's look at returns. Since we are always able to invest in US Treasuries with zero risk, what we really want to know is how much return we have generated above and beyond what we could have gotten risk-free from just buying US Treasuries. This is called the excess return, and is the difference between an investment's return and the return of US Treasuries. Thus, the equation for calculating Sharpe ratios is an investment's return minus the return of US Treasuries, which is the excess return, divided by the standard deviation of the excess return. By maximizing your portfolio's Sharpe ratio, you're maximizing your portfolio's efficiency at converting risk into return. And since different investments are exposed to different types of risk, the impact on your portfolio's Sharpe ratio from adding a new investment is dependent on the Sharpe ratio of the investment itself and the correlation of that investment to your portfolio. This is because some investments will rise and fall in line with one another. They'll be correlated, whereas other investments won't. Therefore, by combining investments that don't move in line with one another, the overall risk of your portfolio, its standard deviation, would be reduced. To illustrate this, let's look at an oil company and an airline. The stock of the oil company will generally rise as the price of oil rises. On the other hand, the stock of the airline company will generally decrease as the price of oil rises, just because the cost of flying planes goes up. However, over time, both the oil company and the airline company are expected to return about 10% per year. But the standard deviation of returns would be lower because the good days and the bad days of these different stocks will occur at different times. To understand whether a potential investment would have improved or worsened your portfolio's Sharpe ratio, you need to ensure that the Sharpe ratio of your new investment was greater than the Sharpe ratio of your existing portfolio multiplied by the correlation of the new investment to your portfolio. A correlation coefficient of 1 means your portfolio moves exactly in line with this new investment, and a correlation of -1 means they move exactly inversely to one another. SharpenPortfolios portfolio analysis tool can help you understand what your portfolio's Sharpe ratio is and also tell you whether an investment would have improved your Sharpe ratio historically. This golden information will help you build sophistication, make more informed decisions, and become a better investor.